The slide in global stocks this year, with new lows in October, has been driven largely by lower price-to-earnings multiples as realized earnings have held steady. However, that steadiness masks an important trend. Expected earnings for growth companies have declined, while expected earnings for value companies have actually increased. Let's take a closer look at how this may help investors navigate volatile markets. The multiple for stocks in developed markets, which began the year at about 19, has plummeted to less than 14. Normally, this kind of multiple contraction would imply a 20 to 30% reduction in future earnings, typical of prior recessions. However, one-year forward earnings estimates for value companies have bucked the trend with a 5% increase since the beginning of the year. In contrast, estimates for growth stocks have weakened more than 12%, mostly in the last 3 months. With the increase in forward earnings estimates, value stocks have outperformed growth by more than 5 percentage points this month. When evaluating the attractiveness of investments, we often look at their relative price-to-earnings multiples. Growth multiples, with higher expected earnings growth, are normally higher than value multiples. So when the spread between multiples expands, value has become relatively cheaper, and therefore we think more attractive. Even with the surge in value stocks this month, the spread between multiples has grown. So value stocks have not only outperformed growth, they have a more stable earnings outlook and are becoming increasingly cheaper relative to growth, a rare occurrence. This trend is not unique to value. Forward earnings estimates have also increased for higher quality companies, which have strong cash flows and return on capital, and lower volatility companies whose sales and profits tend to be less sensitive to economic swings. Including value, we call these groups of stocks equity factors because of their historical tendency to outperform the broad market over the long term. As multiples in all parts of the market have fallen, these equity factors are trading on steep discounts. In the midst of extreme economic uncertainty, mispricings like this can create opportunities for investors. The earnings resilience, current multiple discount, and long-term track record of equity factors like value, quality, and low volatility can make them an effective long-term play.